So markets are not panicking. They are essentially recalibrating uncertainty. This week we've had two overlapping shocks, renewed tariff instability in the United States and a serious escalation in the Middle East involving Iran. Now, the key question for investors is not, is this World War III? It is, what is the transmission channel? Now, if we think about markets, they don't price headlines, they price second-order effects. And in the Middle East, we know at the moment the most important variable, I think it's safe to say, is escalation control. When the objectives become ambiguous, is this a nuclear degradation? Is it a leadership targeting? Is it regime change? The distribution of outcomes widens dramatically. So markets don't need certainty of worst case. They just need a high probability of tail risk. And so the first place that this may show up is not necessarily equities. It could be energy. Energy does remain the fastest bridge from geopolitics to inflation expectations. If oil supply routes are even perceived to be at risk, inflation risk premia could rise quite quickly. And in this regime, I think the margin of safety is thinner and more variable than the last decade. Inflation isn't collapsing to 2% cleanly. Fiscal deficits are elevated. Term premia matters again. We've had long end weakness, which brings us to duration. Bonds aren't necessarily broken per se, I think far from it. But long duration should no longer be just a passive hedge you forget and own, or at least the debate around that should be escalated. In a world where inflation can be reactivated through supply shock, the stock-bond correlation becomes much more conditional. So that means diversification itself becomes conditional in a multi-asset setting. So at the same time, the AI trade is entering its accountability phase. CapEx has been exploding. Return on invested capital is being questioned. Valuations are being compressing, even when earnings are strong. We saw that with Nvidia. So we have geopolitical escalation risk. Energy as an inflation channel, duration perhaps behaving differently, AI moving from faith to much more scrutiny, and credit looking calm, but liquidity structures mattering more and more. It's not a collapse. We're seeing relatively stable indices, but it's a repricing of certainty. And for multi-asset portfolios, the edge right now is not forecasting the next bomb, the missile, the strike, but I think being explicit about exposures. So, for example, what role may energy play? How much of your defence in a multi-asset, multi-manager setting is simply long duration? Where is liquidity risk actually shifting? Are FX exposures thought about as deliberately as they should or they could? Regimes transitioning just don't announce themselves with panic. They often reveal themselves through dispersion and then repricing of assumptions. I think this is one of those moments. Now, I should just say the views in this video are opinions of my own. They're not the views or represent the policies, positions of the Portfolio Construction Forum or any of their affiliates.